Put mine on
Well,
silent.
we might just kick off for the sake of time and appreciate everyone kind of battling the weather to come and join us here today. Really good opportunity here from Dr. David Allen from Plato, the Global Alpha Fund, which is one of our main funds that we endorse. To give a bit of background from it, like my name's Brendan. For those of you who haven't met, you probably know one of either myself, Peter, Bart, Stephen, or Andrew, part of the GP World team here at Shores. One of the big things we really enjoy doing and advocating on behalf of ourselves is the work that the team does and the ability to cover more ideas, put more applied thinking in on the benefit of our clients and portfolios. And this is a great example of that, where we probably meet 2 managers a week, whether it be to a review or an update or a new manager talking about a strategy. And we basically endorse 4 active managers, of which Plato is one. We've done a lot of work to actually combine the managers together to enable them to kind of complement each other. So we're actually able to achieve a lower downside capture or lower volatility of the market, but also outperformance of the market. In hindsight, we probably could have just stuck with Plato and done a much better job, but they've been a great part of our portfolio, and growth and preservation, that's a big part of what we focus on and the work we do as a team. So we're very lucky and privileged to have Dr. David Allen come in and present to us today. Also, given the nature of markets, a good fresh uptake on what's going on around the world would also be welcome to everyone's ears, I'm sure. Quick introduction. For those who don't know, the bathrooms are in the hallway. There's food here. We're recording, so if we can just save questions until the end, that'd be appreciated. There's plenty of time for that. But in terms of a bit about David's background, head of long-short strategy at Plato Investment Management. Very distinguished career spanning global investment markets, has had senior roles at some of the world's most prominent asset management firms with a very deep expertise in quantitative research and long-short equity strategies. He's had more than 2 decades experience in global equities. Prior to Plato, he worked for JP Morgan Asset Management in London for 15 years, one of the youngest managing directors in the firm's history. He managed the JP Morgan European Equity Plus Active Management Fund, closed the new investors after going to 6 billion, generating 4% alpha, a performance above the market, and also launched the new JP Morgan European Equity Absolute Alpha Market Neutral Fund. There's got to be an acronym for that. In the first 12 months of operation, returned over 20%. The assets grew to over $1 billion. In 2014, he was European Hedge Fund Manager of the Year. So very lucky to have him come in and present to us today, and I'll hand over to David and we can action there.
Oh, thank you very much, and thanks again for braving the weather. Yeah, it was pretty treacherous out there. I was on late minute. My wife had a wisdom teeth out yesterday, so I had to. I was on school drop-off duty, and I made an absolute stuff up of it. You know, almost dropped the wrong one at the wrong school, and had to get a late pass, and it was and on the check-in form, it had, reason for being late, get that late pass. And I just wrote, "That is hopeless." So thank you for coming in. So Plato, just for any of you who may not be familiar with it, is it's a great boutique founded in 2006. We've actually got almost 19 billion under management now, very heavily backed by all of the big super funds in the country. And the strategy I'll talk to you about today is the portfolio run. It's called Plato Global Alpha, much more succinct name. And this is a global equities fund. It's all about growing your wealth over time. So accumulating wealth. There's some great funds that Plato have that are income based, that generate 7, 8, 9% income per year. $2 or $3 billion strategies, very popular. But this is all about generating outperformance over the market over time. So the strategy, we've generated almost 22% return per annum since the inception of the fund. And that means we've outperformed the MSCI World. Okay, so that's the broadest global equities market by 12% per year. And that's after all fees. Okay. Out of I was just checking this one, there's 262 global funds run out of Australia, and our performance is the second best since inception, and it's the first best on a risk-adjusted basis. So, we really focus on smooth returns over time, and as much as possible, we try and build something that's very all-weather. predicting the latest geopolitical shifts or macroeconomic moves is notoriously difficult. So we want to build a portfolio that is going to be robust for a whole different range of environments over time. And Brendan just mentioned downside capture before. The downside capture on this strategy is 65%. So what does that mean? It means when the market sells off, okay, the market might be off 10%, say, which of course happens. That means on average, historically, we've only been down 6.5%. So we're preserving capital better for you when markets underperform. And this is what it looks like, the cumulative outperformance of the Plato Global Alpha strategy since inception. Okay, it's that dark navy line right at the top. And you can see it's a really smooth journey. The longer I've been managing money for, the more and more I've become totally convinced that we often think that we want something that's really high octane, high volatility, sex and violence, but when it actually comes down to it, the volatility of that can be so painful that, as humans, we're emotional and we can react and capitulate at the worst possible time if we have had a severe drawdown. So we try and have a very smooth journey for investors. I've got 3 young girls, a 5, a 3, and a 1-year-old. I don't get much sleep as it is, so I need a fund that's gonna be pretty good through the night. So another analogy, and it's a bit corny if you forgive me, is greatest batsman of all time, Australian, naturally, average of almost 100. I don't know if there's any cricket fans in the room, but how many sixes he hit in his Test match career?
Well, 6.
6. Well, you've got Google open. So that's pretty extraordinary. His whole philosophy was very different. He was like, don't hit the ball in the air, don't take unnecessary risk, hit the singles, don't get overconfident. And that was how he built that incredible record. So our approach is very much the same. Rather than getting overconfident on one big macro call or saying it's all about this thematic or that thematic, we have hundreds and hundreds of little bets in the portfolio. Some people would say, okay, well, are you being too diversified? And is that actually impeding your return? But for me, there's in anything, there's multiple ways to win. Buffett, extraordinary track record with a 20-stock portfolio, very concentrated, but some of the most successful hedge funds in the world have thousands of positions. So we certainly haven't found that an impediment towards generating very strong returns, as we've seen. Those faded lines in the background are the 40 largest peers, and you can see sometimes they do phenomenally well, but sometimes they give it all back. That pinkish line, if your eyes are not too bad, is a fund called GQG, phenomenal stock picker. Sometimes gets it incredibly right, but then really got tripped up by the sort of Adani debacle more recently. So smooth return profile, so we can all sleep at night, is very much important. One thing to point out, as Brendan was saying just at the start, is that before I was at Plato, I was 15 years at JP Morgan Asset Management in London, and we had a very similar strategy, similar philosophy, similar DNA. And again, on the right-hand side, that cumulative outperformance in green this time, very smooth. Okay, so we're providing that smooth ride that I think everyone is looking for. So in terms of how we actually go about that, that's easy to say, but how do we actually do it? Well, one of the things that's very noticeable in Australia is many funds that have very big style biases in their approach. So you've got extreme growth funds. It's all about US mega cap tech, or deep value funds like a Platinum that is looking at really cheap stocks, irrespective of everything else. The issue with that is if growth's in favor, that's great. But if growth becomes out of favor, then, think of post the tech bubble, you can be in a world of hurt. So we don't try and be too clever. We've always got some great value companies, some great growth companies, and some great quality companies in the portfolio at any one point. So just to give you a bit of a flavor for holdings in the portfolio, you've got JP Morgan, arguably the best run bank in the world, highest quality bank in the world. They've got a net interest margin, okay, which is, all important for banks. That's 30% higher than our beloved Commonwealth Bank, okay? And yet they trade at a multiple. So CBA trades at 27, 28 PE. So for every, so very, very expensive, most expensive bank in the world, arguably. JP Morgan had a PE of just 11. Okay, so by broadening our lens, you can find some great unloved companies across the globe. BYD, there's a very natural comparison here between BYD and Tesla. Okay, so Tesla, if you can believe it, when I checked this morning, they're trading at a price earnings ratio. So that's valuation simply of over 170 times, right? Okay. BYD is at 85% lower valuation, yet the cash flow is 50% higher and they're growing rapidly. Whereas Tesla, they've had an absence of new models. They've had Elon Musk has been polarizing for some people, and that has caused their sales to go into reverse. So there's some great growth opportunities out there. In terms of quality companies, always good to have some really high quality, stable, reliable companies in your portfolio for when, the geopolitical tensions start to flare. There's a lot of volatility, uncertainty. Having really high quality companies and brands is really beneficial. So, Rolls-Royce almost synonymous with quality, right? But people think of associating them with a car company, but they're really aerospace and defense. And they have massively benefited from the biggest Trump trade of all, which is not US domestic manufacturing like everyone thought it would be, but it's actually been European defense names. For the first time, the Europeans are waking up and saying, right, we have to actually carry the burden and spend what we need to spend on defense. We can't just rely on the Americans anymore. So Germany, for example, has gone from spending less than their 2% NATO obligation percentage of GDP to growing to 5%. Okay, the debt break's been released. So there's just going to be this deluge of funding in European defense. And Rolls-Royce has been a huge beneficiary of that. I think it's up over 400% since we bought the name a couple of years ago. So combining the best of value, growth, quality, this is what it will look like if we're getting it right. So you can see in the first 18 months of the fund's life, it was a value market, it was a bear market, and we were consistently outperforming. So these bars here show the excess performance over the benchmark each month. So consistent outperformance in the value bear market. Then all of a sudden, there's a technological break. There's ChatGPT, large language models, AI becomes a reality, and we're off to a really aggressive growth market. What you can see here is the portfolio continued to outperform very, very well. Okay, so we're not tied to a particular regime, which is very important. And just one final thing on this slide. In March, it was a really great growth, really great value market. The growth companies like the Mag 7, this sort of thing, were crushed, but we actually had our equal best month ever in spite of that. So very much trying to build something that's all weather. So value, growth, quality probably puts you to sleep. They're important investment fundamentals, but something that is absolutely critical part of Plato's secret sauce, I guess, if you like, is we have 150 red flags that are fully systematized. So what that means is that at our fingertips, and we'll do a bit of a demonstration a bit later on, we can bring up any company in the world out of the largest 10,000 companies in developed markets and instantly see what potential risks they have on the horizon. The origin of and we've never seen another fund manager systematize red flags in this way. Everyone has like ad hoc red flags, things that they look out for, but the value is in really having a huge comprehensive set of these risk factors. So the origin of this very quickly was back in, over a decade ago, I was invested in a Spanish technology company. It had gone up multiple times for us. We were very excited about this company. The Spanish Prime Minister even came out and said, this is going to be the biggest tech company in Europe. Should have known when a politician says that we probably should sell. And sure enough, what happened is it emerges it's a huge accounting fraud. Stock price goes to zero. CEO gets indicted for fraud, goes to prison. And we said, wow, well, let's just do a really thorough postmortem, make sure we never go through that experience again. And in that postmortem, we found a couple of interesting things. One of them was that they were paying their auditor peanuts. Okay, which speaks to a not a thorough audit. The second thing, they were using an auditor that nobody else in Europe was using. So being very, we try and be as scientific and as possible in how we approach investing. We've got 20 years of data across 20 different countries and identified every instance where a company is using an obscure auditor. Sure enough, as simple as that is, that does identify companies that go on to be more risky and blow up more often. A couple of interesting examples, like I mentioned Adani before, they were using this tiny auditor, didn't have the ability to understand the complex interlocking set of companies like Adani. A bit closer home, mineral resources. We've been short mineral resources we closed it out recently, and mineral resources has obviously been under a huge pressure as one of the very largest companies in that sector. They were being audited by a group, an auditor, RSM Group. Okay, now RSM Group, I'm sure they do some very good work, but they don't audit another company in the ASX 200. Okay, so and they're paying that auditor a very small amount. So you could almost argue, that they're not being audited. They've gravitated towards a lighter touch auditor, and then suddenly when they move to a real auditor, all these skeletons come out. So that was really the genesis. And over the last decade or so, we've been looking at every corporate fraud, failure, collapse, manipulation we can get our hands on and building up this toolkit of red flags. So think of the likes of Enron, poster child for related party transactions, special purpose vehicles. Think of the big banks like Lehman Brothers, Bear Stearns, where senior executives held no stock in the company. There were no clawback provisions. We've got some excellent data on the history of executives. Have they been involved in misconduct ever historically? We look very closely at director buys and sells. But the only director buys and sells that really you need to pay attention to is if the stock price has been crushed and then insiders are selling in size at that stage. It tells you that the stock price isn't coming back, that there's more bad news on the horizon. Liontown was a great example of that. So the red flags is probably the most powerful way we've ever identified to really do two things. One, identify companies that may look magnificent on the long side, but you really just shouldn't touch, okay? So sidestepping landmines. Warren Buffett always fond of saying, only two rules of investment. Rule number one, don't lose money. Rule number two, don't forget rule number one. And the red flags really embodies that. Cettire is an Australian name, online luxury retail. They've gone from zero revenue to 700 million revenue virtually overnight. They looked like they had this tremendous business model, no inventory, very small number of employees, and they were selling your Prada, your Gucci, your Balenciaga, all this sort of thing for 50% discounts, and it looked, pretty extraordinary. And unfortunately, my wife discovered the website, and I thought, oh, this is great. She's gonna save, all this money, but she just bought twice as much, so it didn't actually didn't come out ahead at all. But anyway, Cettire, the red flags kept ratcheting up. The founder sold a few $100 million worth of stock, had no prior experience in fashion, and sure enough, the stock unraveled after that. We got a bit lucky with the timing. Opthia was an interesting name that one of our big competitors has been entangled with, but they had 18 red flags prior to basically collapsing. So the warning signs were certainly there. So red flags, huge part of the secret sauce. And you put those building blocks together, best of value growth quality, the red flags, and you can see that we've managed to outperform by 12% a year. The downside capture, I mentioned 65%, and we're hardwired as humans to feel losses 2 to 3 times as much as we feel an equivalent size gains. That downside capture is very important. Most funds that have a very good downside capture give up a lot of the upside. Okay, our upside capture is actually 126%. So we're capturing more of the upside when markets appreciate. One aspect that is interesting is that we've generated a lot of the alpha, the majority of the alpha actually from short. So that's when we're betting against companies. Okay. And the red flags is a huge driver of that. Coming out of COVID, valuations were totally extreme, and we had the companies had taken on too much debt. There was a company that we were short called BrainChip that had a market cap of almost 3 billion, had 22 red flags, but had less revenue than my Uber driver this morning. So there's been lots of great short opportunities that have helped drive that short alpha. So really that's the story. We have an active ETF. So this just means that you can buy the fund traditionally as an unlisted fund, or if you have you can buy it through Shores as an ETF as well, which it just means it trades on market and you can get in and out instantaneously, which is proven very attractive. So that's really the story. We've been doing this a long time. I'm heavily invested. Most of my liquid wealth is in this fund, and working extremely hard every day to try and generate some good returns for you. And I want to thank any individual who's invested in the fund, but also Shores for being great partners and backing this fund. I'm also president of East Rugby, and they're sponsors of East Rugby as well. So thanks for that.
Appreciate that, David. Do you want to give us a bit of an outlook on what you're seeing in the market at the moment, given obviously the current state of affairs, everyone's kind of asking you around it. Do you want to give us a quick rundown about that?
Yeah, sure. So we wrote an article several months back saying that our view is that the market had always been so sensitive to exactly what the Fed does, but it suddenly become the Fed wasn't the huge driver. It was really the rhetoric that was coming out of the White House. So that became all important. And in this article, we said, look, we don't believe that Trump is an ideologue. We believe that his only ideology really is pragmatic self-interest. And if markets were to tank, if treasury yields were to blow out, that he would blink. He would blink before the Chinese. He would blink before Powell. And that's actually exactly how it's transpired. After 4 days of those announcements of those extreme, so-called Liberation Day tariffs, he reversed course, put things on a pause. But when he's put things on a pause, it's not like in 90 days those tariffs are going to come into play. I don't think those numbers on that big, beautiful whiteboard that he had we'll ever see again. So I think that's the markets reacted extremely positively to that. We're actually well above where the market was at that point before the tariffs were announced, after plunging quite dramatically. So I don't think the market believes that those tariffs are going to come back either. The concern now is, I guess, is that they, in terms of what happens to long-term borrowing, so 10-year treasuries, if the fiscal position of the US deteriorates, that increases the borrowing costs that they have, and there's a real sort of it was in the AFR the other day. I forget the journalist who mentioned it, but there's a real sort of battle now between the Republican Party, between the country club Republicans, okay, so the wealthy Republicans, and the country music Republicans. So the country club Republicans, they obviously very keen to cut costs and cut spending, cut Medicaid, that sort of thing, to facilitate tax cuts. But at the other end, the country music Republicans are very much, they in many cases rely on Medicaid, and it's a shock to them that some of these programs could be slashed quite dramatically. So there's a bit of friction there, and exactly how it gets resolved will have a big bearing on the US fiscal position, borrowing rates, and borrowing rates obviously will affect equity markets as well. One thing I think that's important with Trump is that he is not to be too reactive, because he'll come out and say one thing with total confidence, and the next day, by the time you've woken up, he may have reversed position. So the worst strategy is to be too reactive, flipping back and forth. And our strategy really is just to stick to our knitting, investing in fantastic companies with great prospects, long, and investing and taking short positions in companies that we think are going to be really challenged, and trying to cut out as much of that noise as we possibly can.
There's obviously a bit of a flow of capital out of the US into China and Europe, and it's kind of semi-eased a little bit. What would your opinion be on that trend?
Yeah, so that's absolutely happened, and we at the portfolio level, we're slightly overweight Europe and Asia and underweight the US, but not huge numbers. Timing different countries or regions is notoriously difficult, but for us, Europe is way cheaper, okay, as a market than elsewhere. But it was lacking a catalyst for a long time. But now suddenly there's some firm catalysts in play. So that's motivating our overweight position in Europe. We've been underweight the Magnificent Seven the whole way through. And, there's some absolutely phenomenal companies there, but valuations are not particularly appealing. And you've got these other sort of various US headwinds at the moment. But I agree, that flight of capital from the US to Europe is moderated and is likely to be not as strong going forward.
You mentioned a couple of thematic, like defense, obviously you've got tech, and are there any other kind of areas that you find that are a bit overlooked from the market and thematic wise that haven't hit mainstream?
Sure, like we've been invested in the GLP-1 thematic for a long time. So this is Ozempic and the weight loss drugs that I think that's a decade-long thematic. They're going to be the best-selling drugs of all time. There'll be 100 billion revenue a year. The market was very hot on that, and then has come off. But I still believe very, very firmly, and that is a long-term thematic. And then I guess financials in general. Like if we're going to see a steepening of the yield curve, the whole business of banks is borrowing long, lending short, borrowing short and lending long. That's definitely going to be supportive for banks. And if deregulation comes through in US banking system, more M&A companies like JP Morgan will definitely prosper.
I did read somewhere that the GLP-1 drugs, because it's behavioural adjustment, it's got applications when like gambling and addiction. And is that a real thing, or is that just kind of what?
Yeah, well, there's definitely it's been written up in the medical journals that people are drinking less, people are other compulsive behaviours. So whether it's going to be a negative for the likes of your Aristocrat and your Tabcorp sort of remains to be seen. Maybe that's a little bit down the track. But it is quite remarkable, and there's definitely going to be a headwind for your like McDonald's had results recently and looked very negative, much more negative than expectations. So those things can potentially start filtering through.
Any other questions?
What's your view on the rollover of US debt that's coming up, especially in the context of where bond yields are at the moment?
Yeah, well, there's a lot coming due, and it's one of the reasons why they were so desperate to get yields down. In the most recent auctions that have been going through, I'm sure you guys have been looking for it. Then the demand hasn't been good.
Yeah.
And the secondaries have had to be coming in and sopping up that excess liquidity. So it is a little bit nerve-wracking. And that can really spook markets if they don't get those away in a fluid fashion. So we'll see. Watch that space. And it's one of the reasons why in our portfolio we take as little risk as possible. Like there's so many things that make for great talking points. Dinner party conversation. What's going to happen with the oil price, inflation, interest rates, but all these things are so challenging to get right. Picking great companies I think is a lot easier. And so we try and hedge as much of that sort of risk out as possible because, as they say, you get 10 economists in a room and you get 20 opinions. So
Yeah.
challenging.
David, with Opthea, you said there was about 20 red flags. It'd be interesting to know what you saw there and what put you away from it. Because obviously your competitor, there was a big fall, big trip up. Or do you just try and stay away from binary trades in general?
Yeah, we try to stay away a bit from binary trades. So we'll just Jamie can actually bring it up for you on here. So this here is Prism. So this is our in-house proprietary software for how we analyze companies. And so I think that maybe internet connection is a bit slow there, but basically you can see 19 red flags currently. But certainly the name didn't rank attractively for us. It was like 476 out of the 500 odd Australian names, and this probably degraded a bit since then. But there wasn't a name that particularly, like a company with 8 or more red flags will virtually just never touch. I remember Volkswagen before Dieselgate, if you remember that emissions cheating scandal in Europe, had 14 red flags. It's a very good predictor of potential trouble on the horizon.
This is on the short side. Do you have anything on the long side?
Yeah, sure. So I'll probably talk through like Australian names just because it's easier for us all to relate to them. So
While you're getting that up, Dave, so you mentioned you're long short, obviously with 150-50. What does that actually mean for someone who invests in the fund?
So very simply, like most funds, it's very, very simply, you just buy companies and hope they go up. We do that, of course, but if we've identified a company where we think there could be accounting fraud or some other bad behavior or the financial stability is really deteriorating, we can take short positions as well, which means that if that company does perform badly, then we can profit from that. So we've got 2 ways of making money in the strategy. So this is JB Hi-Fi, and you can see on when we look at a company, we never use just one valuation model. Like any valuation model, it's got all these assumptions and nothing's perfect. So we'll use an ensemble of valuation models and average out those errors. That's what we're seeing here in these 2 blocks here. In terms of growth, it's middle of the road, quality, very high quality. All these different quality models that we look at look very good. Superb momentum in markets, lots of great revenue, earnings, cash flow, dividends, price, share targets, upgrades, 0 red flags. That's quite rare to see that. You put all that together and the company is ranked 51st out of the 500 odd companies in Australia that we cover. It's actually the 7th best in the consumer discretionary space out of 58. And it's interesting, people talk about JB Hi-Fi consumer discretionary, but these days, especially I guess amongst the younger cohorts, try and tell them that having an iPhone is discretionary and, that anyone's got teenagers. So, they've very much become staples and behaving more like that, very sustainable earnings profile. I guess if you would like to, any companies that you'd like to throw at me, anybody in the room, long, short, see how they look.
Can I just ask a question regarding your whole methodology, right?
Yes.
Obviously, there's a lot of tech involved in what you guys do. I'm not from your space, so
Yeah, sure.
apologies if I'm getting some stuff wrong, right? I just follow Brendan's lead. If you're using a lot of technology to get access to data and doing various things with it to manipulate the data to get the outcomes of your red flags and whatnot, how are you structured for the future? Because all the margin gains that you see that are happening, right? The alphas, right?
Yeah.
The AI technologies that I see that I'm in tech, that I see that are going to wipe those out. What are you doing that defends you from all that?
Well, I guess we don't talk about it too much, but we've got 2 of our 15 staff that are full-time on AI. And and looking at how we can utilize those technologies to do what we do better. So I'll give you a couple of examples of that. We analyze 25,000 earnings calls a year. So these are calls between company management and brokers like Shaw's and fund managers like us and journalists. And in those quarterly updates, there'll be 5 questions, okay, saying, okay, what's your view on this? You know, are you worried about this, et cetera, et cetera. Now, 25,000 earnings calls, virtually impossible for a human to listen to that many, let alone do it objectively and consistently. So that's where we use large language models. So think of like ChatGPT, okay, that can analyze the earnings call transcripts, the written transcripts that we get 15 minutes post those earnings calls. And the primary purpose is to look at sentiment and how that sentiment is changing and how it's comparing to its peers. But we look at many other things. So one of the pieces of research at the moment that we're looking at is to identify evasiveness when they're being asked, management's being asked questions. It's always been something that I've always felt just, gut feel that if someone asks, if you ask someone a question and they don't answer it, you know that the real answer's quite bad. Okay. So it's always what they don't tell you is the most important thing. And so we wouldn't have been able to do this just a few years ago, but now we can use large language models to score each question and answer in those earnings calls to say, how evasive are they being within that? And what we've found is analyzing all those earnings calls going back about a decade, companies that are the most evasive, where they're just sidestepping the questions, the performance of those companies over the next 3 to 6 months is very, very poor. Okay. So this is just, a couple of examples. And, like I agree with your point that, you need to, remain on the cutting edge of technology. Otherwise you can be left behind. But certainly, within Australia, there wouldn't be many other fund managers that are pushing the boundaries as much as we are in that space.
Yeah, appreciate that. I think one of the big things we really like is that we're always trying to find with managers that have got a bit of an edge or a different way of approaching things to be able to complement long-only strategies we might have within the portfolio. And so we've asked David to really kind of focus on some of the areas that they do and execute that a lot of other managers simply are not, and most of them cannot do in the same way. So hopefully this has been a good insight to it. We'll be hanging around here and feel free to grab a bit of food, and appreciate everyone coming and joining us here today. We'll have a recording for this to follow up if anyone wants to, kind of have a listen to that as well.